Here on my channel, Duke of Early Retirement, I've talked a lot about early retirement, retirement accounts, all sorts of investing concepts, and I also have a lot of videos about selling options through strategies like the wheel. But I've never talked much about my own investment portfolio and how I actually invest. Today, that changes. I want to pull back the curtain and share with you exactly how I invest my money as I get closer to financial independence and early retirement. And I'll start by introducing you to the Pareto Portfolio. But let's get this out of the way up front. I'm primarily a buy and hold investor. I've dabbled with individual stocks in the past, but that's out of my system at this point. Aside from some option selling, which I'll address later in this video, I'm a buy and hold guy all the way. And the most important decision about any buy and hold portfolio is the asset allocation. Asset allocation is about spreading your money across different types of investments like stocks, bonds, and cash. It's like having a mix of ingredients in a recipe. The right balance helps manage risk and aims for the best growth based on your goal and how comfortable you are with risk. Typically, the more comfortable you are with risk, the more stocks you would have in your portfolio and the less bonds you would have in your portfolio. The bonds help smooth out the volatility of the portfolio, so portfolios with a higher percentage of bonds will be more stable than the overall stock market. The most famous asset allocation out there, especially for retirees, is the 60-40 portfolio. This is where you would have 60% of your funds in stocks and 40% in bonds. It's a solid and time-tested mix, but if you're not in retirement and you're still accumulating assets like I am, you might have a more aggressive asset allocation like 70-30, 90-10, or even 100% stocks. I have my own specific asset allocation that I aim for in my investment portfolio. It allows me to set my asset allocation and keep it there without a lot of second guessing whether it's the right mix or not. I call it the Pareto Portfolio, and it's named after the Pareto principle. The Pareto principle, also known as the 80-20 rule, suggests that in many situations, roughly 80% of the effects come from 20% of the causes. This principle pops up in various areas of life and work. For instance, in a business setting, around 80% of sales might come from just 20% of customers. Or in personal productivity, 80% of your achievements might stem from focusing on the top 20% of your tasks. Well, in the Pareto portfolio, having 20% in bonds handles the risk mitigation piece, leaving 80% of the portfolio to grow in the stock market. For me, it's a way to say to myself, all right, I'm gonna have 80% stocks and 20% bonds. There's no need to overthink it. That asset allocation is good enough for me. Not too risky, not too conservative. It gets the job done. It's simple. And it's something I can stick to long term regardless of what's happening in financial markets. So my overall portfolio is the Pareto portfolio, 80% stocks and 20% bonds. For many people, this isn't conservative enough, especially in retirement. For others, it's too conservative. Everyone has their own risk tolerance, but 80-20 works for me and my mindset, and I plan to stick with it even through retirement. This is also considering that I'm planning to take a pension at the age of 60 at the latest, possibly earlier. The pension won't be enough to cover all my expenses, but this added layer of safety 15 years or so down the road allows me to be more aggressive in my portfolio right now, more aggressive than I would have been otherwise. So the Pareto portfolio is good enough. Again, I'm not overthinking it. I picked this asset allocation and I'm sticking to it. As for that 80% in stocks, well, I have that split between US stocks and international stocks. Not all US investors choose to include international stocks in their portfolio. I know that many just stick to US stocks, and time will tell if they made the correct choice or not. For me, I like to have the additional diversification and include international stocks in my portfolio. In fact, I made a video on reasons to include international stocks in your portfolio, which you can check out here. So I've got international stocks in my portfolio, and here the Pareto portfolio strikes again when I ask myself, how much international stock exposure should I have? Within my 80% of stocks, I'm aiming for an 80-20 split between US and international stocks. As a percentage of my overall portfolio, that works out to 64% US stocks and 16% international stocks. Then there's the 20% in bonds. For For bonds, it's all US bonds. I don't mess with international bonds. I know that Vanguard includes international bonds in their target date funds, but for me it seems unnecessarily complicated and risky. If I did add international bonds, I would split it up in a ratio of, you guessed it, 80% US bonds and 20% international bonds. But I stick to US bonds only. The bonds are there to smooth out my portfolio like shock absorbers against the volatility of the stock market. How big of shocks do you need? Well, for me, it's 20%. Pareto Portfolio, baby. But I don't just have US stocks, international stocks, and bonds in my portfolio. I also dabble in some option selling strategies to generate income. Option selling is tricky to fit into a traditional asset allocation. From a risk perspective, the option selling strategies that I do, like the wheel strategy, are somewhere between stocks and bonds, but much closer to stocks, I think, because they have almost all the same risk that holding stock does. So, is selling options its own thing separate from stocks, separate from all other investments? How does it slot into my Pareto portfolio? Well, my option selling almost exclusively uses US stocks as the underlying, so it probably belongs there. What if 80% of my funds that are allocated to stocks are straight up US stocks, and 20% of those are my option selling portfolio? In this case, the asset allocation looks like this. Take the entire asset pie, 20% of which goes into bonds, and the remaining 80% is divided up like this. 20% of the 80% remaining goes into international stocks, and that leaves 80% to be divided among US stocks. So 80% of that remaining to go into US stocks, and 20% of that remaining to go into the option selling strategy. So as a percentage of the total portfolio, we would be looking at 20% in bonds, 51.2% in US stocks, 16% in international stocks, and 12.8% in the option selling strategy. This might start to seem like it's getting a little complicated, but this actually is more true to what I'm trying to achieve with this Pareto portfolio. 20% in bonds is a core piece of my asset allocation, so I don't want to mess with that because that's messing with the risk level of my entire portfolio. But by including option selling activity within US stocks, I just have a slight modification within the US stock portion of my portfolio. So that's how I'm allocating my option selling, cash secured puts, covered calls, and the wheel strategy. But what about rebalancing? Over time, as assets move up and down in value, my asset allocation can get out of whack and drift away from the ideal Pareto portfolio. When this happens, I have to adjust my assets periodically so that the allocation is back to what I want. I do this in two different ways. Since I'm still in the accumulation phase of investing, I buy more of one asset class than another to try to tilt the balance closer to the Pareto portfolio. For example, I might redirect my HSA investments to buy bond funds only for a while. If I can't rebalance enough through gradually buying specific assets, then I need to sell off some funds and buy others. This is easy to do, especially in a tax-advantaged account where there are no tax implications. I sell stock funds and buy bond funds, or vice versa, or sell US stocks and buy more international stock funds. In a 401k or 457, I might even switch into a more or less aggressive target date fund to try and adjust my overall stock bond mix closer to 80-20. What about cash? Cash doesn't factor into my asset allocation as a set percentage. That's mainly because I don't see cash as an investment. It may earn some interest, but with cash, I'm just trying to keep it from losing value to inflation as best I can. It's not an investment. Very recently, I've started dabbling in buying and laddering T-bills, and while I like it so far, and it is earning more than the inflation rate for now, I don't know that I'll be laddering T-bills for the long run. It depends on where interest rates go. If you're interested in that topic, check out my recent T-bills video here, but I do keep cash around to meet upcoming expenses, not to generate more wealth or income. I like to keep anywhere from 6 months to 1 year of expenses in cash. And I'll likely lean closer to that 1 year of expenses in cash as I move into early retirement. Having a good amount of cash in the bank helps me sleep well at night, and that way I'm prepared for planned and unplanned expenses without having to sell investments when I don't want to. Now, when it comes to buy and hold investing, I focus on index funds and lowest cost options available because simplicity and efficiency matter. High fees and tax inefficient investments slow down the compounding effect in a portfolio, and that really adds up over time. That's why I have a preference for the low-cost passive index funds for each type of asset that I want to invest in. These are funds that aim to match the performance of a specific asset. Their goal is not to beat it. They're passively managed and they track a specific benchmark for a specific type of asset. Because they're passive, they minimize buying and selling within the fund as well, and that generates very minimal capital gains, also very tax efficient. When it comes to US stocks, I prefer investing in the total US stock market fund, such as VTI. For bonds, I prefer a total bond market fund, such as BND. And for international stocks, I prefer a total international stock fund, such as VXUS. I own all of these funds, but these aren't the only funds I own. And I've got some others, especially in my 401k and 457, where total market funds aren't offered. But these funds are my ideal, and I'm trying to align my entire portfolio to these three funds as much as possible. I really like this simplicity, and I don't think I can outsmart the market over the long term, so I just want to invest using funds like these to match market performance for as low a cost as possible. As far as asset location, I have my investments spread out over different types of accounts with different tax advantages and disadvantages, different rules for when you can take out money and how the money is taxed. And this tax diversity will be an advantage, especially in retirement, because I can be strategic about which accounts I pull money from and when. This way I can control how much tax and what kind of tax I pay in a given year. Right now, my investments are split across accounts like this. I have 31% of my investments in a taxable account, 52% of my assets in pre-tax accounts. This includes 401k, 457, and my HSA. I have 15% of my assets in Roth accounts, and 2% of my assets in 529 accounts. There's no correct mix here. The point is to have a variety of account types. Obviously, if I could snap my fingers and turn all the money that's in pre-tax into Roth, I would, but there are also advantages to upfront tax deductions from pre-tax accounts and flexibility with taxable accounts that I've enjoyed along the way. So I'm happy to have a mix of account types. To review, the Pareto Portfolio is my guiding light. It's all about that 80-20 balance, and within stocks, the 80-20 split between US and international markets, and within US stocks, the 80-20 split between US stocks and option selling strategies. The majority of my portfolio is buy and hold. I use index funds and low-cost funds such as VTI, VXUS, and BND, and that's because they offer diversified exposure for a low cost. My strategy is tailored to my goals, risk tolerance, and other factors. It's somewhat conservative. Even the options part actually reduces risk of my portfolio, but it works for me as a set it and forget it approach. I've also got a nice mix of tax advantaged and taxable accounts, and diversity of taxation will also serve me well in retirement, as I can choose how and when my income will be taxed. So that's how I invest in the Pareto Portfolio. Your investment approach may differ, and that's okay. It's important to find an approach that you can stick to over the years. Find what aligns best with you and your path toward financial independence. All right, that's what I have for you in this video. If you found this helpful or interesting, give it a like, and don't forget to subscribe to my channel for more videos on saving, investing, and early retirement. Thanks for watching. Pareto Portfolio, baby.